It's nearly 1 year on from the devastating triple tragedy which hit Japan back in March 2011. Growth expectations for Japan have been slashed in the wake of the earthquake and tsunami in March, which were closely followed by the nuclear disaster. Alongside this, the strong yen and state of the global economy has created challenges for exporters. Joining me now is Tim Condon, Chief Asia Economist at ING Financial Markets in Singapore. Tim, on the upside, analysts are now suggesting there's a potential for a much-deserved boost to the Japanese economy, given the fact reconstruction programs are finally commencing and signs of an improving US economy. What's your outlook for Japan this year and into 2013?
It's important to note that before the global financial crisis, Japan was, I think, about a 1.1% trend growth economy. That was the average for a long period of time. Then global financial crisis really hit Japan very hard. Growth bounced back nicely after that, and actually Japan grew at a 4.5% in 2010. Then, as you point out, last year was a terrible year for Japan. It was hit by these real shocks. The earthquake in March was devastating, but damage from those kinds of shocks is a lot less long-lasting than the damage from the global financial crisis. And the downturn last year was not as steep, and as a consequence, the bounce in 2011 won't be as big. We're looking for a 1.5% growth in 2012. That's after a contraction of almost 1% last year. And some of that is simply the low base from a year ago, but also the reconstruction spending is going to give a fillip to growth. For 2013, we have growth slipping back into its long-run trend, which we calculate has really not changed. It's still 1.1%. So we have this kind of transitory dip and then bounce and then smoothing out again, and as Japan reverts to its trend performance.
Last year, Japan's trade balance fell into negative territory for the first time in over 3 decades, driven largely by energy imports. Despite the March 11 disaster, Japan has been facing a number of economic challenges for years, including a debt-to-GDP ratio, the highest among developed nations, and an aging population. It was predicted the disaster may turn out to be GDP positive because of the rebuilding that would follow. But it appears the elements which are affecting Japan's economic and financial stability seem to be mounting, are they not?
Japan's debt is a mounting problem, and it will have to take measures to reduce the burden that debt imposes on Japanese taxpayers. It is far from clear, however, that problem has to be solved or measures have to be taken immediately to put that problem on a more sustainable footing. The issue of the trade balance it may be serious in the sense that if nuclear power now is going to be phased out in Japan and they're going to be relying more on imported energy, then we could see the trade deficit in Japan persist. It typically the trade account typically moves into a deficit when the economy is hit by a serious shock. And it has been hit by a serious shock. It was in 2008 with the global financial crisis, and this is another one. It may not be as quick to snap back into surplus given the structural change in the composition of imports. Big question mark, I think, for Japan is what's going to happen to its financial policies, monetary and fiscal policies, and whether or not these are going to be more pro-growth, which would enable Japan to grow out of its public debt problem, or whether they keep Japan on this what has been a 20 years of more or less steady deflation, which ultimately is going to make the debt problem even more difficult to resolve.
We've seen a burst of yen weakness in recent days, which has seen it fall to above 81 versus the US dollar and over 107 against the euro. Data showing currency speculators have turned short on the yen. Is there room for dollar yen to go much higher in the short term, or do you think the upside is limited?
This is the area that holds the most hope for the Japanese economy. The recent weakness was triggered by the surprise easing by the Bank of Japan in the middle of February. Concerted easing by the Bank of Japan would send the yen much weaker against the major currencies, against all currencies, in fact, and that is precisely what Japan's economy needs, much more accommodative monetary policy. My baseline scenario is that is not what we're going to get, that the Bank of Japan has kind of been dragged kicking and screaming to that this most recent easing that we've seen. What we're going to see, experience in other countries, notably the U.S., since March 2009, with their quantitative easing, demonstrates that when you time-bound, you announce in advance how much quantitative easing you're going to do and over what period, the benefits in terms of monetary accommodation are transitory, and Japan has done that. There's a hope that they will do more, but at least at this point, my baseline scenario is that we've seen what we're going to see, and the weakness in the yen has now largely run its course.
Thank you very much, Tim, for joining me on DukascopyTV. Now, to keep you updated and informed, there'll be more exclusive interviews, press reviews and currency projections throughout the week. Make sure you stay tuned.